Hello and welcome to this week's episode of the Monday Call. I'm your host, James Gregor, and it's safe to say that a lot has transpired in just the first 2 weeks of April, and we're here to break it all down for you. And today I'm joined by Mark Brooks, Chief Investment Officer at NZ Funds. So Mark.
Morning, James.
Thanks for joining us again. I know it's pretty busy out there. Monday morning is always a bit of respite because markets are closed everywhere other than New Zealand. But a few things we want to discuss this morning. We'll deep dive into the actual tariff announcements and the subsequent tariff announcements and the subsequent ones after that. Yep. We've also had updates over the weekend. We're going to explore what these tariffs could mean for the economies of the US, New Zealand, and the global landscape. And I guess we'll also discuss NZ Fund's positioning of client portfolios in the times that, some people would find, quite scary for some and others just uncertain about what's going to happen.
Sure.
I think first I want to make one comment, and that is history shows us that in volatile periods, patience pays off for investors who are willing to buy when it looks challenging, but also just really not do anything in periods where markets are volatile. So I think, we're going to go through some charts and see some market reactions that do look relatively scary, but actually in context, it's things are behaving as one would expect when there's volatility, but it's no different to how we've seen markets behave and react over the last, I guess when data started, really.
Exactly. That's probably an interesting segue to say that we're doing something different this time. We've actually got a presentation on the screen. I know a lot of people potentially just listen to this in their car as a podcast. So we'll do our best to sort of explain each slide as we go through. But equally, I think with the final version, there will be a link to the slides if people want to see them.
So should we get started? Let's go to first the disclaimer. I guess just making sure that what we're going to be talking about today, for those of you that are looking at the slides, is just general observations on the market rather than anything particular to do with people's personal circumstances. So this isn't advice. This is general comments that Mark and I are going to make. So let's start at the slide that hopefully a lot of us have already seen before if we've read our first half report that we released a month or two ago.
Yeah. I think, as we started the year, we sort of thought about what factors are driving investment markets, what are sort of front of mind for people. And, on the screen, we've got a series of bubbles, which are sort of the size of the size of the discussion and how much people were interested in discussing it. And really, there were two, sort of one positive, one negative. The positive was very much that story from last year, and I think a continuing story of AI and what is that doing to productivity and to change the landscape of business and how we interact with computers in many respects. And the other one being the negative, being trade and tariffs. So obviously that one is clearly to the fore at the moment. But making that point that because of one positive, one negative, we came into the year with the view that actually, things could be a bit more bumpy. We probably didn't expect them to be this bumpy this quickly, but certainly things were not all positive in terms of the outlook. We still felt that we could see, and we still do feel that you can actually end up with a positive year for share markets. But in many respects, we did expect a step along the way, which would be probably more the scenic route rather than the motorway that we've seen over the last couple of years.
I think one observation also is that with all these bubbles on this chart that talks about different drivers of market, just because one overtakes in terms of the news flow doesn't mean to say the other ones disappear. So, there's things that we haven't discussed in a long time that perhaps, are bubbling away in the background, still doing really well. Like when I look at this chart and think about the pharmaceutical sector and obesity and some of those new drugs that are available in the US are just incredible things doing to reducing healthcare costs and things that we haven't discussed once for months because of this. So it's important to remind all of us, including ourselves, that these bubbles don't stop and just wait and pause for the one that's dominating to take over.
Well, I think also it's that point that the one that is dominating, because it is dominating and people are talking about it, markets are very efficient at pricing in what is expected. So if it is dominating that discussion, to a degree, it's going to be significantly in the price already. The main point here is that in terms of the tariffs that have been announced, what they've announced are not really tariffs ultimately. They are very much more tariffs that are based on trade balances. And if we look at the various numbers that were initially announced back on the 2nd of April, what we've seen is that those numbers are very much based around the relative amount of imports that the US is importing versus the amount of exports they have. So in New Zealand's case, broadly we send about $5 billion of exports to the US, and we import about 4. So from that point, the other way around. The number is, we import about 5 and we send about 7. So the number's about $2 billion. Of that, it's 20% of the number, essentially. So from that point of view, they've taken that number and said 20% and dropped it in half and said 10, and that's where the New Zealand 10 comes up.
So this chart that we're looking at, for example, therefore, for those that are listening, when I think about India with 52% tariffs that India charges US, actually it's got nothing to do with tariffs, really. All it's to do with is India exports a lot more to the US than they import from the US. So, I guess that is something that perhaps they're trying to solve for something rather than necessarily trying to, really truly reciprocate the tariffs. And I'm going to get another few charts up if everybody bears with me.
So you've got us back again for a second, yeah.
While we look at, because we've sort of got it
right.
So this is a much better representation of what we were just talking about in terms of it's based on trade, not reciprocal tariffs. So it's not based on the fact that India has these tariffs that they're going to reciprocate. It's all based on this chart, which is a much better representation than a table, which is showing the trade deficits versus other countries.
Yeah, exactly. And for those who are listening to this, essentially what we've got here is a chart that goes back to 1980 and says really since that point in time, the US has continued to run a trade deficit with the world. And that has continued basically to increase, mainly fairly unabated over that time frame. And you've gone from a fairly balanced trading system in 1980 to one where now the US is essentially has a deficit of $1 trillion a year. And against that, we have various other countries. The largest is sort of China, with in terms of a balance, somewhere in the region of sort of 600, high sort of 500, 600 billion a year. Germany also has, sort of probably around about 200 billion a year, and then a various array of other countries. And really, that's the key is, the use of that word tariff is a misnomer. It is really a discussion that the administration there is wanting to restructure the trade balance that they have. Interesting enough, this is very much trade they're talking about. If you look at this in a services context, in many respects, the US exports more services than they import, so they tend to run a service balance, a positive service balance. But from a trade point of view, they've got a sort of a large negative. So really what they're doing is effectively saying, look, we're importing more than we're exporting to you. Either we need to import less, and we've got these tariffs to encourage that, or frankly, you need to buy more from the US. And we've seen in the past that has been the case where countries have agreed to buy more, and maybe it's sort of stealing the thunder further on, but certainly that is part of the process here, is that they want to sort of bring different people to the table.
What's interesting is that point about services, because none of this is talking about the service exports, so to speak, that
about
the
your
US
Netflix and Prime Video and things like that.
And actually, I think there's been a few surveys out, and I can't vouch for any the source of it, but what's interesting about it is that most Americans don't want to go back and work in big factories, up against coal furnaces and that sort of thing. They do want to be in an office and providing more, being in the service economy rather than the manufacturing economy. And I don't know if you've seen those AI generated videos of Americans working in shoe factories and iPhone manufacturing factories. It's you're going to get tit for tat on both sides, but it's an interesting point. They might do all they can to supply these sorts of jobs back into the US. Whether that actually happens, because it's going to take decades if they do, but do people actually want to work in those places?
But ultimately, that's still the key part. Is there is this discussion of tariffs, and everybody was sort of going, well, how is that tariff? Do people actually charge those tariffs of the US? Well, generally the answer is no. It's just actually might have been vastly simpler if they'd said, look, this is our relative trade balance, and we do want to improve it. And I think there might have been less consternation with that approach.
So we've been over this chart again. Is there anything more you want to discuss around the actual Liberation Day announcements?
I think the only point to note is, if you look down that list, we really have only seen China announce some sort of retaliation. And as a result, the initial tariff charged of sort of 67%, we well know now, has been sort of effectively doubled from that level through a series of steps. And it probably does highlight, and probably the other one is that we've seen that the reciprocal tariffs, in which for many countries sort of started in the 30s or the 20% type region, that has been temporarily suspended for 90 days. And ultimately, that's probably on reflection shouldn't come as a massive surprise, because is the infrastructure there to actually manage all of these tariffs? Any negotiation process is going to take time. Somebody made the point that I think the US-Mexico free trade agreement, or Canada-Mexico free trade agreement, took somewhere near 2 years to agree during Trump's first presidency. So it does take a little bit of time.
And I guess the point of all this was to get people to the negotiating table, and if you were going to be sort of polite about the volatility that's caused from the announcements, but polite around the intent, it's getting people to talk about these trade deficits.
Exactly. Now, if we sort of move on and say, well, what has been the reaction so far? Essentially, the chart on the screen is we've got S&P and NASDAQ performance. This is year to date. Remember also that originally both markets had a pretty strong start to the year. January and February were strong. In fact, both, and certainly the S&P had an all-time high on towards the end of February. And since that time, those markets are down year to date. S&P is now down about 10%, NASDAQ down about 13%. That follows a very strong bounce in markets the middle of last week when the tariffs were paused for 90 days. So definitely a sort of I suppose an unwind of the really negative scenarios. And it's probably we should go through those scenarios, or we will in terms of coming slides. But so markets broadly down, just over 10% for the year, and off the highs, probably sort of somewhere closer to that sort of 13 to 15% at this point. But and very much we're closer to a minus 20% number. That would be sort of your classical bear market, I suppose, demarcator.
What's surprising is when you're sitting there Saturday morning having breakfast, markets were actually up for the week.
Yes,
which was phenomenal given the volatility and the rhetoric and the headlines and that sort of thing. And really, it was the week before where the damage in terms of market sell-off was happening, and actually we had a positive end to the week, or positive week in markets despite all that.
with some fairly big moves along the way.
Yes.
Yeah. And what does that mean? And we always, for those who listen to this podcast a bit or the Monday call a bit, we talk, I think, a lot about context and always about for financial markets. It's about trying to put the moves that we're seeing or the events that we're seeing in some form of context. And in terms of the US share market, with 10-15% declines are significant. Maybe not enormously uncommon, but they are significant. But essentially, if we put that in context, it does take us back to levels that we were broadly about this time last year. So, 2024 was a good year for the US share market. And really, this has unwound a significant chunk of that. But if we think back to the last time in which we had really significant uncertainty, and probably global uncertainty, was really the COVID period, right? And we remember sort of starting this podcast based out of our homes and garages and things like that. And,
on a telephone where people had to literally dial in, which was unheard of now. I don't think I've ever dialed on a landline for some time.
But if we sort of put that in context again, the chart here shows what is the S&P, what is the US share market done over the last 5 years. And we're really since that sort of low in the COVID period. And there have been plenty of ups and downs along that way, but the market is significantly higher than it was at that point. So, again, trying to put it in context, we think is helpful because markets do have these periods. It's one reason why you are rewarded with some quite good returns, 10% per annum share returns on average. That includes events like this because that uncertainty tends to scare people off, frankly, and they forget about these sort of issues that, if you look back 5 years, those markets are well ahead of where they were at that point, despite a lot of the uncertainty along the way.
Yeah, this is one of the classic charts that I think you're going to present today, Mark. And for those who aren't looking at it, it just shows that you can have this volatility, but if you are in the market for a long period of time, you're going to generate strong returns. And it really, episodes like we're going through now are difficult, but even with that priced in, the returns that you've generated since COVID has been significant.
Yeah,
and it's just we repeat it over and over again, but it's the Warren Buffett, it's time in the market, not timing the market.
Exactly. So just sort of stepping back from the market, I suppose, why have we got this sort of uncertainty? Why have we got this volatility? Well, I suppose it's, at its simplest, what the concerns are, what are the worries driving markets are really three things. One, tariffs and significant tariffs will cause US inflation to be decently higher, somewhere in the mid 3%, maybe even up to 4% type region. That's from somewhere in the 2.5s. Question there is, and I suppose the concern is that tariff in and of itself is just like a GST. It is a tax, and it will, a one-time rise in GST does increase CPI, but it's only at a point in time. After that, it shouldn't have a flow-on or ripple effect. The concern and one of the worries is that potentially, because of the breadth and size of the tariffs and being imposed, that inflation will move higher, but it will also stay higher. That's one of the concerns. But to some respect, that really gets mitigated by the other concern in that, higher costs for the US consumer, will it slow growth? And will it slow global growth? Ultimately, people can't sell as much if trade is restricted. That diminished demand, diminished sales ultimately hits people's revenue and earnings around the world. So the concern is that tariffs generally will slow growth. And I think, certainly from a most would acknowledge, I think even many in the US administration would acknowledge that tariffs generally are a negative, and they tend to reduce the level of trade, which is has been very beneficial for many countries over the last 20 or 30 years.
I think what we need to remember is if you are importing something and there's a tariff on it and it goes up in price, and if you versus a company that's manufacturing it in the US, you're not going to leave your prices where they are either. You're going to put them up because you might not make it as expensive as the imported good, but you probably increase it a little bit because that's an easy way to increase prices. And so it affects all products, not just the ones that are being imported, one would expect.
Yeah, although there is that issue of, if people, I suppose one of the aspects that we saw during COVID was that, there were supply shortages and people, because of it, actually the government stimulus, had money in their pocket. So, whilst they may not have been happy about it, there was a willingness to, they wanted the item, and in fact it was more expensive. Oh, well, we'll pay for it. Now, there may be, you'd probably expect if the things are generally more expensive and life's a bit tougher in terms of consumers, that actually they won't have that willingness. There won't be that elasticity to sort of.
So then you could get a bifurcation in prices where the US manufactured stuff do stay down in price a bit to get those sales because the economy's a bit tougher.
Yeah.
Interesting.
And the last one really there is, moving from global to US specifically, do you actually see that if the tariffs get put in place as they're fully suggested, broadly that, you had an economy that was coming into this year that was very strong, somewhere around about sort of 2.5 to maybe even sort of 2.7% GDP before inflation. So when you add back inflation, add another 2.5% inflation, you were looking at an economy that was running at circa 5%. So from that point, that was really strong. Are these tariffs enough? It's one of the concerns. Are these tariffs enough to actually pull all of that growth out of the US economy and actually bring it back into recession? And ultimately, that's what the market is trying to. I think there's a famous comment. I think it was potentially Donald Rumsfeld, another fairly famous Republican, that talked about sort of known unknowns. What do we know out there, or what don't we know? What do we know is potentially also out there in terms of responses to this? And really, again, there's sort of three things. One, and so much of what we talk about at times is what central banks do. If we look back over that sort of 5-year period when shares were up in the US, actually a lot of that came when the Fed was raising interest rates, much like the Reserve Bank here has been raising interest rates. They haven't cut interest rates as much. So what will they do? Clearly, what deals will be done? And will countries have deals? And then what will other countries do? We've seen some fairly robust responses from China. Generally, other countries have been pretty quiet so far. So what will they do? I think they're the unknowns that are likely and probably likely to come to the fore over the next couple of months. And just dealing with each of those in turn, if we think about, and the chart here shows the federal funds rate, which is the US version of the OCR. And for those who haven't got the chart, essentially it starts at April 2020, and for 2 years the federal funds rate is basically at zero. They then, and we well know, took interest rates up, much like the Reserve Bank did, really from zero to a high of sort of 5.25% in the US. They have cut rates, and they started cutting rates in the back half of last year. And they've now moved the rates down to 4.5%. So from that point, we've seen rate cuts, but there is a significant room for them to cut rates if they feel it is appropriate. And remember, the US Federal Reserve has a dual mandate that is both to keep inflation low, but also to maintain full employment. So I think if off the back of this, if they start to see US job growth, poor US job growth numbers, and start to see unemployment rising, there is a lot of room for the Fed to move in terms of cutting interest rates. Again, we've talked a fair bit about that concept of neutral. What is a neutral interest rate? And broadly, I think, again, much like New Zealand, the neutral interest rate in the US is probably a touch lower, but sort of somewhere between a cash federal funds rate of 2 and 3%. So if they're sitting there in the mid fours, from that point, there is a lot of scope they have to cut rates, even just to get back to what might be perceived as being a neutral rate, let alone something which is actually is positive and looking to actively stimulate the economy. So, there is a decent chance we could see another series of significant interest rate cuts out of the US, taking that cash rate, certainly into the low 3% region, probably somewhere in the low 2s as well.
I mean, that is a phenomenal looking chart in terms of just really highlighting how much wiggle room the Fed does. And this is when people talk about the Fed put, this is what they're talking about.
Yeah.
The fact that they can keep cutting, isn't it? And we're not suggesting it gets down to zero like it did in COVID. I mean, when you look at the chart and look at what was going on during COVID, you can understand why asset price inflation was so high when you basically debt is free. But there's a lot of wiggle room there, even down to your sort of 2 to 3% range.
Yeah, and look, I think the Fed will give it time, and there's certainly their comments so far is that they want taking a watching and waiting approach. But I think the key point is to watch employment. If we see weakening in employment, I would expect the Fed to move after that.
And so, just briefly on New Zealand, that mandate is now no longer in existence in New Zealand, is there? It's just inflation.
Yes, correct. Yeah.
And so perhaps, we might, I guess that's one of the reasons why they've been probably a bit stickier with the cash rate in New Zealand versus, say, perhaps the US at the start anyway.
At the start, yeah. It's fair to say, we've seen more interest rate cuts in New Zealand ultimately. And again, that comes back to the starting point of the economy. Ultimately, the US, they slowed down and I suppose stopped the process of cutting rates because actually the economy was really strong. Unemployment, we've talked before on this, employment remained robust, and unemployment was really in that sort of low 4% range and wasn't changing. Whereas in New Zealand, growth has been poor and unemployment has been rising. So from the Reserve Bank's point of view, there's been clear reasons to cut interest rates. And it's probably fair to say you did see, last week we saw the Reserve Bank announcement. They cut interest rates by 25 basis points, but equally they, given the uncertainty out there in terms of tariffs, were actually probably suggesting that there is more scope at the margin for them to cut rates further on this year.
And I guess that's a wait and see, probably US-led almost, or is US-led, depending on what they do about global trade and tariffs and things like that. But again, New Zealand does have ammunition to deploy if they need to, in the sense of they're able to cut rates further as well.
Exactly. In terms of that sort of next known unknown is really, what deals will we see? And very much, I suppose, again, that idea of context, if we think back to Trump's first term, we did see, it was a tariff discussion primarily with China, almost exclusively with China at that point. But we did see deals. They had agreed to less tariffs on the basis of agricultural purchases, soybeans mainly. And from that point, we've seen that, and I think there was one of the issues or one of the things that emerged last week is really you only saw China choose to take the stance of pushing back in terms of putting on their own tariffs. Others talked about it, but really didn't push it forward, which does suggest, and we've had confirmation since, that many other countries are looking to come to the table and find a negotiated way through this. I think the other one which if we just go back for 1 second, James, the one thing that we also need to remember is if we think about the US administration, they've talked about a number of things going into this at a broader level. And one, it's about sort of, they're trying to ultimately do two things, I suppose. One, they want to bring back a degree of production to the US. They want to ultimately probably create jobs for the middle class and the lower middle class. Ultimately, that is that's really why I suppose, or it's a reflection as to why Trump was voted in, was that support from the broad populace. So they want to bring activity back to the US. Two, ultimately, they want to also reduce the deficit, or the degree in which the US government is spending or outspending what they bring in terms of revenue. For a number of years, they've been running deficits in the region of sort of 4, 5, 6% of GDP, really big numbers. So that's their aim. Certainly, tariffs are aimed at getting production back to the US, but it's also, potentially raises some income for the US government, but it's a drag on activity, clearly. Against that, what is their aim to balance that activity? And it's about saying, well, they are looking and have talked extensively about tax cuts, and certainly continuing the existing tax cuts that are due to roll off, but also on top of tax cuts, look at regulation. And there is, generally the Republicans are being right-leaning, are more of a small government type approach, and they're very strong in sort of saying that the regulatory confines for a lot of US business in areas like banks and other financials are really disincentivizing activities. So from that point, looking to get, I suppose, tax cuts with money into people's pockets and encourage business activity through lower regulation is the sort of yin to the yang, I suppose, in terms of tariffs.
Because there's a little bit of mutually exclusive there, where you want to onshore production, but you want to generate revenue from tariffs, and I think that I was commenting on it earlier today, where actually onshoring jobs and the production of goods in the US will take a long time.
Yep.
And first and foremost, perhaps it is that revenue generation to fund tax cuts. In which case, I guess, taking that forward, you could assume, therefore, that tariffs aren't going to be taken away completely in Trump's negotiations, but there'll be something there to generate some revenue to cut taxes, but perhaps not to the extent that he initially announced, because if you slow the economy down too much, then revenue comes down anyway, and then you don't get the tax cut taken, you can't cut taxes because your deficit's so high. So he's probably trying to find the balance, and I guess other presidents would have perhaps tiptoed a little bit more. We're getting used to Trump's hard line when it comes to saying things and doing what he's saying, but in the end there will be some tariffs, but perhaps things are going to come a bit more, because they won't be to the extent, because otherwise it defeats the purpose of generating that revenue.
Yeah, exactly. And I think that idea of balance is useful. I know we've talked about it a bit. Trump very much has his rhetoric and his style. You listen to some of the others in the administration, like Treasury Secretary Besant, more measured, talks more about finding ways to find that balance. I think that's important.
To put the budget deficit, not the budget deficit, the debt to GDP in context in the US, they've got about 120% debt to GDP versus New Zealand, which is about 50. So it really shows that with US large deficits and a lot of government debt, they really don't have many ways that they can fund tax cuts. And so when you take a step back, you think, actually, this is you might not agree with it, but you can understand where they're coming from.
Yeah, and look, I think, and we've made this point a few times, the US government is relatively small compared to the wider US economy. The US economy is a $30 trillion economy. US government revenue is about 16 to 18% of that number. In fact, significantly smaller than New Zealand government revenue relative to the size of our economy. We're much closer to sort of 28, 29%. So from that point, their debt to GDP is high, but it's not necessarily a problem. It's more about, what is their ability to basically cover their interest bill relative to how much does that take out of their ability to spend elsewhere. And they're looking to rebalance that. I think, as we sort of move on from tariffs and think about sort of, I suppose, where we're positioned and what is the opportunity, and ultimately, what should clients expect? I think the first point, and this is intentionally sort of a fairly blunt and poor English, bad England, I think is probably the best. NZ Funds is not the United States. And, we think that's important, is that, so much of, frankly, what we talk about, because the US is a big part of global markets, and it's so much of what's in the news headlines, is that people automatically think that is what they have. But I think if we look around different areas, we've spoken, and back at the beginning of the year, part of the discussion was that we did feel that, the year, whilst we felt it would be positive, would be more bumpy. There would be periods where the markets were negative. And we also felt the expectations for the US were very, very high. And we sort of pointed out around that there were other areas of the global markets, specifically Europe, China, and New Zealand, that actually looked very cheap. And the expectation levels were much, much lower. So from that point of view, again, if we think about where we are in terms of the different markets now, most markets have been drawn, have fallen in line with where the US has. So frankly, there haven't been many places to hide. But if we think about going forward, it's those markets where, they remain cheap, they have an ability to continue to grow ultimately, that will be positive. And if we look at somewhere like China, clearly that is in the crosshairs of the tariff discussion. And to a degree, there's a lot of chest beating going on in both parts. I think there was a very interesting piece put out by the Chinese, what they call a white paper, the middle of last week, that was basically, and hopefully I paraphrase this correctly, they said, they're going to have a very robust pushback against the US, but ultimately within that, and they didn't want to be bullied, but within that, they think there is a way forward. They want to find a way forward because they think that a negotiated solution is best for everyone, ultimately. And, in many respects, that's not dissimilar, despite the rhetoric that Trump's saying. Again, he sort of says that Xi is not such a bad guy. He's a guy much like himself. And, you've got a lot of chest beating, but potentially those do come to a point where they actually find some agreement there. The other one I think is useful in terms of China is that, China exports everywhere. 15% of their exports go to the US. It's a big number, but it's not dominant. So from that point, it's not the only thing that drives that economy. And we would expect that, again, it is a controlled economy, so they have significant ability to stimulate there. So, actually, we think that's potentially one of the markets that might surprise this year.
And can be, from such a large economy, quite nimble. So already last week, they've signed natural gas agreements with Australia, so they don't have to import it from the US. And sort of, I guess it's a way of playing tough, I guess, because that's an export that the US potentially loses. It's probably not much in the scheme of things, but it just shows the nimbleness and the fast decision making a country like China can take compared to the EU or something like that, which perhaps is slightly slower.
Exactly. Yeah, even though it's big, the joys of being a controlled economy. They can be nimble from that point of view. We've talked about Europe a number of times already this year. We think there are some real opportunities there. And again, and I think New Zealand's probably the best example of this. New Zealand's had a pretty tough year so far. Went through a difficult earnings season, which was really a reflection of how slow the economy was at the back half of last year. Generally, it's come through this most recent weakness relatively well because it was already down. But if you think about companies here, do tariffs impact Meridian Energy? Do they impact Spark or Chorus or something like that? Yes, there are some companies that are impacted, but big chunks of the New Zealand share market have very little impact from that point of view. And the other one would be for New Zealand, if we think about where ultimately we're an exporting country, but with the New Zealand dollar down where it is here at sort of near the lowest levels we've seen in sort of 5 or 6 years, that is really positive for our exporters. And many of our exporters, yes, they'll have stuff going to the US, but it's not necessarily, again, a bit like that Chinese example, a dominant part. So, milk, we don't send a lot of milk to China. We do, it's larger, to the US, sorry. A lot more goes to China.
Especially baby milk formula and things like that.
Exactly. And, other areas like beef, yes, a decent amount goes to the US, but actually others may not, perversely because of tariffs, look to import from the US. So actually may look to import more from places like New Zealand.
The other thing about New Zealand, which you sort of alluded to faring well, is it really just comes down to valuations, doesn't it? US had some fantastic returns over the last couple of years, and their shares were expensive, and that versus New Zealand, which unfortunately hasn't had a great run over the last 4 or 5 years. I think the market, the 5-year COVID anniversary passed. This was before this volatility, but the New Zealand market over that 5-year period was down 12%.
Yeah.
And so things that are cheaper go down less.
Yeah.
And with New Zealand looking to have lower interest rates, you pointed out, Mark, around some of that dairy and the dairy prices looking to recover quite well. Actually, there are some really good green shoots in New Zealand and leading into a cheap share market.
Yeah, exactly. And I think it comes back to that broader level that, for a number of years, in fact, probably for the last 5 to 10 years, the global share market has become, or assets have been drawn into the US because it's been the best performing market. Probably one of the themes we see coming out of this is a more balanced allocation that people will look to have across different markets going forward and not so focused on the US. And ultimately that's kind of what we've been arguing with our positioning, that other areas like Europe, China, and New Zealand actually are pretty attractive going forward.
Good segue.
Yeah, exactly. Conscious we're sort of pushing on in time. So just in terms of where we are, in terms of both the growth portfolio, I suppose the two main areas for client portfolios, the growth portfolios, and we've got a chart here, a KiwiSaver growth, which is a good proxy for the growth strategies that clients may have in the APS service. And broadly, well, first of all, we are at this point fully invested. We've taken the view, and we did reduce positions after the tariff announcement. We've taken the view now that actually you have, with this path in terms of negotiation, there's going to be noise, but there is light at the end of the tunnel. And it does suggest that, again, that playbook of, as we've seen previously, quite extreme starting points, moving to something a bit more reasonable, will actually be something which is positive for markets. So we've moved back to a fully invested position, being able to buy assets at levels, frankly, that are much cheaper than they were just a month and a half ago. So from that point, we are invested. But if we look at the allocation, and that's the prime point of this, is that, again, to that prior point, clients aren't 100% in the US. If we look at their allocations, the US is still a big part. It's sort of, in the high 50% region. And Europe, 18%, China and Asia, broader Asia, 10%. Importantly, almost 40% is in New Zealand and Australia for clients' growth portfolios. And then a smaller allocation to other assets, things like gold and copper and a little bit of Bitcoin, etc., and some bond allocations there as well to as a sort of a downside mitigant. So from that point, clients have a very diversified portfolio. The other one that might be worth touching on is, we still have, and we've talked about this a fair bit in the past, the downside strategy with Universa. And, I suppose ultimately, I've had a couple of questions as to, has that kicked in given the moves we've seen? Generally, we were getting quite close to the point where that starts to increase rapidly in value when the market was sort of down at its worst, sort of close to 16, 17%, and the NASDAQ down 20. But that happened over a slightly longer period. This sort of more recent move has been probably at its worst was around 15. So, we were at a point where, that if things had got a lot worse at that point, the Universa position would have been able to cushion those further moves down. But at this point, essentially markets have rebounded, and that hasn't had a material impact either way on portfolios.
There's some work that some of the analysts in the investment team did around recoveries, and you have this protracted recovery over a long period of time. I'm thinking 2008-9. I think that took 3 or 4 years to get back to highs after that. Essentially, there was concerns that the banking system was broken within that sell-off. Versus say COVID, or perhaps now where that there are shocks in the market, but actually the fundamentals of a majority, and there will be some individual companies that are hurt, but for the majority of companies, it's once the shock of the announcements flow through, perhaps it's not as bad as initial expectations. Actually, that recovery is quite fast, and it's more like a V-shaped recovery rather than a what was an L shape where it goes down and across the page for a while and then sort of starts dribbling back up. Actually, a V-shaped is much more prevalent in a shock sort of environment, and so despite all the what's going on in the second start of the second quarter of 2025, there could still very well be, and what we're looking at now is positive share market returns come the end of the year.
Yeah, exactly. I think you can sort of further break down, I suppose bear markets, periods when shares fall a decent amount. We're almost really into 3 types of events. You touched on the 2008 one. That's really when you have something broken in an economy, and they tend to be deeper and much longer. Certainly in terms of coming out, they can be up to 3 years before you sort of fully come out the other side. The other two are really sort of events, and we tend to see this as an event. They can be quite short-lived, and as you say, quite V-shaped in terms of their recovery, and you get back to that previous high pretty quickly. The other one's probably just more a sort of stock standard cyclical recession, and they can be somewhere in between a year and 18 months in length. We're probably we don't see that the economy is broken, ultimately, is the first point. So we don't see this as being a big protracted down.
And that's somewhat to do with those bubbles at the start of the podcast you were talking about, with there's still things like AI and other drivers of the market that still look really positive.
Yeah, and US consumers still have good balance sheets and don't have a lot of debt, and et cetera, et cetera. So from that point, that is off the table. And really the discussion is this just an event that will pass quickly, in which case you really do get the V, or is it a little bit more of a cyclical where you get that cyclical slowdown, and actually, maybe it takes 6, 8 months, a year, maybe a touch longer to sort of come out the other side. We don't know, but generally either way, being able to buy assets at these prices puts portfolios in a good position if we look ahead a year or 18 months. Again, for not so much for, I suppose, KiwiSaver clients tend to be more focused on the growth space, but in terms of the APS, the advised series, clients tend to have a larger space in the inflation strategies, which are ultimately designed to be more defensive type growth assets. And we've used KiwiSaver inflation strategy here as a proxy for those strategies. And again, as we've said a number of times, half of that allocation is to New Zealand assets. So we focus on 3 defensive categories: property and retirement villages in New Zealand, utilities, and infrastructure. And from that point, really half global, half New Zealand. And the point there would be that many of the aspects first of all, many of these companies are really quite shielded from tariffs because they're very domestic. Also, two, aspects that impact a utility here in New Zealand are very different to the things that impact a utility in Australia or Japan or America. So they're quite separated in terms of their performance path. And in this area, I think it's important. We have, usually we've run this portfolio somewhere around about sort of 80% shares and 20% cash and bonds. We've made the decision with the low prices that actually this is a good time for these more defensive categories to be fully invested, and ultimately, use the power of these defensive categories when we're able to buy them much cheaper than what they were to position this portfolio for the year ahead and for the next 18 months ahead.
Makes complete sense, especially where interest rates are unlikely to go
exactly.
At least up. They might flatline from here, but there is risk that they continue to fall.
Again, many of these assets are quite, in inverted commas, bond-like because they've got very stable earnings. And if interest rates are falling, that tends to be, that's a positive for these assets because they do get measured against interest rates often.
So concluding comments, Mark, why don't you, it's been an hour. We've discussed all parts of the market, but what will be really interesting is to think about how we're thinking about markets going forward. I was interrupted by my phone, which was a text message, and it just made me think about it as which should be off, by the way, but it's an Apple. And, already we're seeing that's been taken out of the tariff. So we're slowly seeing backtracking and slowly perhaps normalizing somewhat as the days and weeks go forward.
Yeah, look, I think the nice thing about the last week is we've probably taken off that hard tail of a really aggressive response from the global community and, sort of an all-out tariff war across different countries. That's been taken off the table. People are willing to talk. We still think we're going to see a challenging 6 to 9 months. We're not out of the woods. This is a change to the global process. So, things need to settle. But, ultimately, we do think, and it's reflected in positioning, that this is an ability to, again, buy assets 10 to 15% cheaper than what they were, very recently. Many people were sort of worried they were buying assets at really elevated levels a little while back. So that's been solved. So I think, from a client perspective, continue to tranche in if you're adding to portfolios. If hopefully people have regular contributions. It's a great ability to be able to buy in progressively over time in terms of assets at cheaper levels. And back to those sort of simple adages that or actually probably the main one is for clients who brought in post-COVID, it was really difficult, but they've got great outcomes. We think this can be that sort of situation now. And back to your sort of point about sort of markets that come off really sharply, we don't think this is going to be a really protracted economies broken type situation. So generally, if markets come off sharply, they often rebound quite sharply.
Mark, really appreciate you taking time out to come and chat to us live. For those that want to have another listen, this is going to be put on through all our podcast avenues without the slides. But if you do want to have a think about what some of these slides look like as you're listening, then do get in touch with us, and we'll be happy to share some of the slides that Mark went through today. So thanks, Mark, and thanks everyone for joining us this morning, and look forward to speaking same time, same place soon.
Thanks, everyone.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.